If it's a choice between fighting and them having a nuclear weapon, you have to do what you have to do.
Hello and welcome to the Week Ahead on Nomura Podcasts. I'm Dominic Bunning, head of G10FX research for Nomura in London, and today is Friday the 20th of June. Market dynamics in the last week have been dominated by developments in the Middle East, where the ongoing military action between Israel and Iran continues to have a notable impact through both investor risk sentiment and on oil prices. As we heard in the short clip at the top of the show, President Trump appears to be weighing direct US involvement in the region, and the situation remains very fluid as we record this podcast. Equity markets appeared to shrug off the initial drop seen last Friday when the first headlines on the topic emerged, but have since resumed a downward trend, and oil prices remain close to the highs with concerns that shipping through the Straits of Hormuz could be impacted. Bond movements have been choppy, but generally yields have moved lower, perhaps reflecting more their safe haven appeal than market concerns over potential inflation risks. In FX, the dollar's safe haven appeal has also come back to the fore as the greenback has outperformed its G10 peers in the last week. Some of this was also likely in reaction to a more hawkish FOMC meeting, which we'll be discussing shortly with David Seif in New York. We're also going to be joined by George Buckley to talk about Europe and Uben Parasueles to talk about Asia. So with plenty to cover, let's get started.
Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer-run objective.
Well, we'll start with the US, and I'm delighted to be joined here by David Seif, our chief economist for developed markets based in New York. David, we just heard a short comment from Jerome Powell there talking about the elevated uncertainty in the economy, and part of this is probably due to geopolitical issues. What do you think the main impacts are for the US and more broadly for developed markets in terms of the recent developments in the Middle East?
Hey, Dom. Well, great to be back here. So far markets have really taken the developments in the Middle East in stride. Yes, of course, oil is a little bit higher, but you're not seeing broader markets really sell off, at least in a sustained sort of way. And I think to be honest, I think part of this really deals with the fact that this looks to be a conflict where one side is really, Israel is really doing a lot better than the other side, Iran. And I think it's these prolonged conflicts that really can lead to the most amount of market negativity. A great example of that, of course, is Ukraine and Russia still going on more than 3 years, almost 3.5 after it started, when sort of the quote unquote conventional wisdom was that Russia would win in a week or two. That conflict continuing on indefinitely led to persistently higher energy prices, and of course was negative for global GDP, particularly Europe. Here it appears that it might actually be a different situation, that things are so one-sided that it doesn't have the same ability to disrupt financial markets or the real economy, I should even say. And I think that is, that really does bode well, just from a market perspective. Of course, there are all sorts of humanitarian issues here, but from a purely market perspective, it does bode well for the situation almost no matter what happens. If the U.S. gets involved, I'm sure there'll be a knee-jerk reaction from markets. But I would continue to expect the markets to generally take it in stride.
Yeah, and I think that reflects pretty much what we've seen on the FX side as well. The positive impact for safe haven currencies have been fairly short-lived, and I think that's probably a reflection of everything you spoke about. So away from that uncertainty, Powell's obviously looking at the data in the US. We had the FOMC last week, and you've got this kind of story where maybe some of the soft data has been weak, the hard data has been a bit more solid. There's nuances to how inflation may or may not develop. When you look at the US economy, do you kind of see things as being glass half full, glass half empty? And how do you think the Fed's interpreting that based on what we heard on Wednesday?
Yeah, well, I think the bottom line is that although we did not see the sort of deep collapse of the economy that some people feared after Liberation Day, things are slowing. And so there is a very real glass half full and glass half empty interpretation. And I think the bottom line for the Fed is that they don't know what that's going to be. It's hard to believe, barring a real breakdown in data, that anything prior to September is on the table for the next Fed rate cut. So 3 months from now, basically. Our view, of course, is that they will not cut until December. But the market is pricing in more than a 75% chance of a cut in September. I think that really more than anything, Powell's press conference and arguably the statement itself was marked by the Fed wanting to keep its options open. So our interpretation was that it was a slightly hawkish conference or meeting, particularly the press conference. Certainly, if I had heard Powell speak and not known what the dots were half an hour early, I would have thought that this was consistent with them having moved not just the 26 and 27 dots hawkishly as they did, but really the 2025 dot hawkishly as well. And I think the message was inflation is going to rise more than they thought in March. That was made clear by the projections they put down. And inflation will be more persistent. That was based on the projections that they had for 26 and 27 inflation. And the labor market's going to be okay. Yes, they revised up their expected unemployment rate a bit, but not much. And remember that previous projection was before Liberation Day itself. So it was a pretty small uptick in their projection for the unemployment rate, given all that has happened in the past 3 months in the U.S. And so given all that, sort of inflation's going to be worse than we thought. Labor market's still fine. It's hard to argue that that equates with anything other than a hawkish move as the most logical sort of reaction to that sort of data. And honestly, I did think that was what Powell's tone was by and large. But I think, bottom line for them is why commit right now? There's a lot of data coming out in July, in August, even in early September about where the U.S. economy is evolving. And with this being the largest increase in tariffs in the United States in 95 years, there is a lot of uncertainty. There could be more or less inflation than we think and than the Fed thinks, and there could be more or less unemployment than we or the Fed think. And so why commit now? I think that was arguably the biggest sort of takeaway that or constraint on what Powell said.
Yeah, I think that makes a lot of sense in terms of the uncertainty. I mean, you mentioned inflation there. I mean, I think this week, probably the most important data point, or one of the most important data points, will be the PCE numbers for May. It looks like our forecasts are for that to be still relatively soft based on the CPI and PPI data we have. But this is still for you a relatively sort of temporary softness.
Yeah, so our forecast is that it will be 0.2 for core PCE, rounding up. It is a pretty quiet data week. We have almost all of the inputs into core PCE already, so there's not an enormous amount of scope for surprise on that. But I agree that certainly is the most important thing coming out this week. The bottom line is that it was clear from the CPI data alone that there really aren't huge signs so far, or there weren't, at least through the May data, which is what we have so far. There weren't huge signs of tariff-induced inflation. Now, we do still think this is coming. I think that there may very well be a delay in things, simply because it takes a while before first tariffs are implemented, then they're collected, and then they're passed on to consumers. But we do certainly recognize, again, that perhaps things will come in more softly than we expect. And so there are risks to the dovish side, certainly, that are emerging. I would also point out, though, that there is a sort of opposite interpretation of this, which is arguably a little bit hawkish, and that is that what if tariff-induced inflation is still coming, as we expect? but it's simply going to last for longer than we expect. Not that it's not coming. Well, a lot of our rationale for the Fed cutting in December was that by then we thought a lot of the tariff-induced price pressure would be in the rearview mirror. If it's still going on once the December FOMC meeting rolls around, then maybe even that is too early for the Fed to cut. And so I would not say that the risks are one-sided here on the dovish side. I do think there's definite two-sided risks to our view. One in that the Fed cuts earlier, but the other that the Fed doesn't cut in 2025 at all.
Great, thanks, David. Interesting to see, still a two-sided risk there when we're moving to Europe soon to talk to George. And there it seems like the risks, at least for most central bank outcomes, have been more to the dovish side. So certainly some interesting divergence happening still in terms of those outlooks. Thanks again.
My pleasure.
Moving to London and Europe, where last week we saw 4 major central bank decisions. George Buckley, our chief European economist, joins us. George, thanks for coming on. We had 4 quite distinct central bank meetings in the last week, most of them skewed towards the dovish side. Can you tell us, pretty quickly what happened, but also have any of your forecasts really been impacted much by these decisions?
Well, they've certainly kept us busy over the course of the last few hours. Perhaps the most exciting of all of them was the one which we thought was going to be the least exciting. That's how it goes, of course. We had Norway, which cut interest rates for the first time this cycle, which is equally interesting that it's taken them quite a while to get to this point. That's because inflation's been a bit more sticky. But they cut. It was 17 economists surveyed by Bloomberg thought they wouldn't, including us. So it was a surprise. They're also highlighting the possibility of 2 more cuts this year. We think they'll be cutting this year and into the first half of next. But everything else was broadly as expected. The SNB cut interest rates by 25 basis points. There had been a risk of something more than that, but they opted on 25. We think there'll be another one. That will take us into negative territory back there again, something that the chairman of the SNB was concerned about but is willing to do if need be. We had the Bank of England earlier today, they decided to keep rates on hold. The biggest surprise there was we had 3 votes for cuts rather than 2. And finally, the Riksbank also cut interest rates, which was expected. So 3 cuts, 1 hold, and 1 big surprise.
Yeah, and generally, I guess, as I said, a lot of that did skew to the dovish side. Inflation has been a big issue. Maybe those pressures are settling down. I think one question the market's grappling with is what is the impact of what's happening in the Middle East on various economies? For Europe as a whole and to some extent individually, do you think we're going to see more upside risks to inflation, or do you think this is going to be more of a risk to the downside in terms of demand?
Well, it's good you asked that question now, because at the end of next week, we do start to see the European inflation figures for June get drip fed into the market, starting off with the French numbers and also the Spanish numbers. I don't think the ECB is too worried about the whole inflation outlook at the moment, especially for France and Spain. The Spanish numbers we think are going to be unchanged. France may be up a bit, but we're looking at well below 2% inflation there. And as you say, there is now a sizable risk that oil price rises when we've seen probably about $15 a barrel increase over the last month and a half, and especially over the last week or so with the step up in Middle East concerns. There is a concern that could actually filter through into inflation. It has offered opposite effects, of course, on economic growth and inflation. It's damaging for growth because Europe's an importer of energy. It's positive for inflation for obvious reasons. But that's the sort of juxtaposition that the ECB and other central banks really need to grapple with. What do they focus on? I suspect it's probably going to be the negative growth outlook from increased uncertainty and increased oil prices rather than the positives on inflation. Last point on this is that we've been there before. Not that long ago, where energy prices, food prices in the aftermath of COVID and the war in Russia, Ukraine had a huge impact on inflation. Of course, double digits in some countries, they'll be very wary.
Yeah, I mean, as you say, it takes a bit of time often for that to pass through. But I guess on the sentiment surveys, we could get a little bit of a faster feed through of those rising geopolitical tensions. We do get the PMI data, the flash PMI data on Monday. Do you think that's going to show any sign of that negativity, or is actually Europe sort of still in a bit of a positive tailwind from the combination of German fiscal stimulus and actually the simmering down of some of the trade tensions we saw previously? How do you see the PMIs playing out?
So from next week's PMIs, I think it's more the latter. So we've got a positive number on the PMIs, a slight increase, very modest, about half a point increase on the PMIs in Europe. The reason we've got that is because we've already had a couple of surveys out, major surveys from Europe, the Centix survey, the ZEW survey. We also get the IFO survey from Germany next week as well. But I think all of those are sort of been pointing upwards. But of course, there are major negatives going forward if, for example, the Middle East crisis gets worse and uncertainty increases.
Great, thanks, George. Clearly a lot to focus on there, lots of potential upside and downside surprises. So always good to have you on to tell us exactly how to think about it. Thanks very much.
Thanks, Dom.
We'll finish this week in Asia, where we have Yuban Parasueles, our chief economist for ASEAN, and fellow podcast host joining me. Yuban, thanks for coming on.
Hey, thanks for having me, Dom.
So look, we've discussed the impact of the Middle East on a few of the other regions. How are you guys thinking about this for Asia? Is it having a big impact on any of our views in terms of growth or central banks?
Yeah, so it's an important focus for us this week, especially in the context of surging oil prices. That's always a negative for the region because a lot of us here are major net oil importers. So from a current account perspective, I'd say it would be negative for places like Thailand, Philippines, and India the most. But I'd say a bit more positive for Malaysia, especially if, the surge in oil prices could be accompanied by other things like LNG prices that could be more impactful. But when it comes to inflation, we're not panicking. We're still keeping our forecasts unchanged despite the oil price increases. And the main reason really is the buffers are there. In other words, oil companies have sufficient net margins. In Thailand's case, they've set, for example, diesel prices higher than market prices, even before this, to help the oil fund, right? So it doesn't necessarily mean that they'd have to adjust diesel prices higher. Maybe the gap just narrows. And then for those other countries where subsidies are non-existent, the starting point is very low. So inflation is either below the central bank's forecast or their target by quite a bit. So even with the current levels of oil, if it stays there, we're still, in some cases, not getting inflation even back to the central bank target. So in terms of our forecast and monetary policy, no changes there. We're still thinking rate cuts in throughout the course of the year in places like India, Philippines, Indonesia, and Thailand. But there's quite a bit of divergence as well because some central banks have started to sound hawkish, like the Bank of Korea. Then I'd put in that camp CBC, where the economy is kind of doing very well, so they didn't have to do anything. And yeah, that was the case this week. And then finally, in Malaysia, like I said, the relative winner in this environment that supports our out of consensus view that BNM doesn't have to cut rates. They can keep things on hold for a while.
Great, thanks, you. But the point you made actually interesting on India. Certainly, one of the currencies we think in Asia probably underperforms almost regardless to some extent. But certainly, this oil price surge not helpful from a currency perspective either. Beyond all of that, something that we've almost lost sight of, I think, is the trade tensions, given everything else has jumped in front of it in the news flow. But clearly, we're getting closer to that 9th of July deadline. You guys have written a big note about the impact of trade and maybe some of the trade diversion that's going on in Asia. Can you just talk us through the key highlights of that piece and what you think is interesting from that front?
Yeah, we've looked at these trade diversion effects, particularly in Southeast Asia, in a bit more detail. And what we found is it's quite clear from April that China's exports have been rerouted via these third countries to circumvent the tariffs from the U.S. And that's important because, as you said, we're getting close to the July 9 reprieve period or the end of that period. And, the trade talks have been ongoing and, we don't see any progress. And we know one of the key demands from the U.S. Is to clamp down on these trade diversion effects for these countries to eliminate that. So if the evidence is quite clear that from April these things are happening, and then there's not much progress in the trade talks, the risk that we see is the deadline expires and the tariffs go back up for some of these countries. And that we've tried to estimate that. And for some of these Southeast Asian countries, we think if the purpose of the U.S. is to eliminate this trade diversion effects, we could see tariffs go back up to, say, 20 or 25% for places like Vietnam and Thailand, where these effects are pretty evident. So, we're not going back to Liberation Day tariffs. I don't think that's pretty likely, but it's still pretty punchy at 20 to 25% U.S. tariffs.
Yeah, I think it is notable that, markets have sort of stopped thinking a little bit about tariffs. And even though there's been basically no deals, one deal maybe with the UK half done over the last few weeks, but not that much progress, it seems. So clearly some risks emerging on that front. So that's really interesting. Thanks, Ewan. Just to go into one more thing in a bit more detail, I know that there's been a few developments locally in Thailand on the political front, which could potentially impact markets. And we've got the BOT next week as well. So do you want to just give us your thoughts on what's happening in Thailand in terms of both politics and also how that's potentially impacting the economy?
Yeah, absolutely. Thailand has been a key focus in a lot of our discussions with clients in the last few days. Again, triggered by the latest political developments. So what happened was the second largest party in the coalition, Bum Jai Thai, decided to quit the coalition. So that's leaving the Pheu Thai-led coalition with barely a majority in parliament. And so the questions people ask is, are we going to get into this situation where we need to they need to dissolve parliament, or we have to have a new election? And so that really hinges on what the other parties, coalition partners, will do. And so far this morning, we had a little bit of a relief in the sense that these partners have said that they will stick with Pheu Thai and support the prime minister. So at least for now, some of the adverse scenarios have been avoided. But again, it's still a very fluid situation and, something to watch because uncertainty is still quite high. Now, that brings us to the BOT meeting on Wednesday. So again, a key focus for markets as well. They've cut a few times already. So the question is if they're going to deliver another one. We think that's going to be the case. That's our baseline because the economy is not doing very well and financial conditions are pretty tight. However, we would highlight that this is a relatively close call because in recent weeks, the BOT's communication has been again starting to sound a little bit more hawkish. They want to preserve policy space after they've cut a few times already. So there is a decent chance that they might pause at this upcoming meeting. But again, our baseline is, because the economy is not doing well, I think it's reasonable to expect them to keep going with the rate cuts.
Thanks, Ewan. Pretty whirlwind tour there of Middle East, impact on Asia, tariffs and local politics. So thanks a lot for your time. We really appreciate it and we'll speak to you soon.
Yeah, thanks, Dom.
That's us done for this week. Thank you for listening to The Week Ahead, which was once again edited and produced by John Dalton. If you're enjoying the podcast, please do share it far and wide with anyone you think would be interested. You can share and subscribe to Nomura Podcasts on Apple, Spotify and SoundCloud and wherever else you get your podcast from. You can also leave a review to let us know what we're doing well and what you want to hear more of. For more, please log in to nomuraconnects.com to keep up to date and to keep on listening. Thank you very much and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, One Investment Bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.